It looks like the futures are mixed right now. Joining us to talk about what to expect, what direction from equities and the bond market is Matthew Diczok. He is the head of fixed income strategy for Merrill Lynch U.S. Trust. Also covering the equity angle, we've got Ed Campbell this morning. He's portfolio manager at QMA. And gentlemen, thank you for being here, both of you. Ed, I want to talk about these kind of countervailing opinions that are taking place on the street right now. You've got companies like Goldman Sachs and Morgan Stanley saying you could be hitting some sort of a peak when it comes to equity valuations. I think Morgan Stanley is only looking for 2750 on the S&P 500 at the year end, and that's just above where we are right now. And then you have BlackRock coming out and saying, no, we're doubling down on U.S. equities. We think what we're seeing in earnings is really important, and we like it more than ever. Where do you kind of come down in this?
So I guess we would lean toward the latter view. I think the 10% correction that we had has taken out a lot of the froth that we had built up. Where in January, based on very strong fundamentals, low volatility, and one-way upward price action, we had simply gotten too exuberant. So we had gone a very long time without a 10% pullback in
Although
equities.
we've kind of made back. So more than half of those losses we've already made back up. So
True.
Do you like stock prices here? Or
Well, I think bottoming is typically a process, right?
Yeah.
So it would be pretty unusual if we had this, 10% correction. We got it all back in a couple of weeks, and then we were off to the races again. So I don't think it's unusual to see equity markets down again. I think we might have to move a little bit lower and consolidate for a while before we shake this off.
But
so I think
would you be
bullish.
telling people to buy right here, or would you be saying, wait, if we're still looking at a shaking out process?
We've been buying because we don't think we can time this too perfectly.
So you're fine with valuations here based on what's been happening with.
Yeah, I think valuations have come back into a more reasonable range where they were definitely getting ahead of themselves in January.
Matthew, let's talk a little bit about fixed income because Joe pointed it out this morning. We've been talking about it all the time, but the front page of the Wall Street Journal today points out that bond yields near 3%, and that's potentially a turning point for investors. You think that's really the case? At 3%, do you suddenly look at bonds and say, okay, this is the place to be?
We don't think it's a magic number. We think it's fantastic that rates have gotten to 3% so quickly, and actually the markets have handled it fairly well. So we're very positive on higher rates. We expect them to go up a little bit more throughout the year, but we think a lot of the move has been baked in already. And a lot of it has to do not just with what's happening in the U.S., but what's happening globally. If you look at where German rates were beginning of the year, they're basically a one-for-one move with U.S. rates. So
what are we talking about now? 70 to 80 basis points for
so
the
about
German
70 basis points right now in German bonds. And so the spread between treasuries and bonds have moved up almost one-for-one. So we talked about this last time I was here, that in order for U.S. rates to move up, you need to see a rise in global rates, and we're starting to see that. So if that continues, you can see us push past 3% this year, which would be wonderful for savers and a lot of U.S. investors looking for additional yield.
But you say that these rate hikes that we expected to see this year have already been baked in. Are you expecting 3 rate hikes from the Fed this year?
So we've been calling for 3 rate hikes for a while. The market started out the year thinking 2, and now the market's moved to 3, and now people are starting to talk possibly about 4. We're still in the camp of 3 right now. 4 is a possibility, but we're thinking it's going to be 3. We think a lot of the move in treasuries has been front-loaded this year. It's been a very quick move up to almost 3%. So I think it's probably going to stabilize here for a while. To Ed's point, we think the equity market is going to, bottoming is a process. It probably might retest the lows. So that should probably keep us in the range we're in treasuries at for a little while here.
What are the risks, I would say, Ed, if you start looking at equities here, the risks that something else shows up? And what do you think caused this pullback to begin with? You think it was just a little too much too fast?
I think what caused the pullback was the rapid repricing in fixed income assets and the fact that we were over frothy in equities. That being said, I don't think rising rates are going to be a big obstacle for equity markets. I mean, our research shows that equity multiples and equity returns do better in a normal interest rate regime than in an ultra-low interest rate regime, because in an ultra-low interest rate regime, that's signaling deflation risks and a sick economy. So normal is better for equity markets.
But do you agree with Matt that we have seen kind of the shakeout in yields at this point?
I think yields could possibly go higher, but I think the majority of the move has already been put in.
Is there a point where you would say, wait a second, this doesn't look like the same valuations I would expect because we are seeing so much more yield in the bond market?
I mean, we would
3% a tipping point. Or
no, I think we would need. I think we would need to go past 3.5, or at some point where I would be really concerned about the impact of rates on the equity markets.
So what do you like right now? Would you tell people buy broadly? Do you like U.S. stocks versus European?
Yeah, we would say buy broadly. I think European and Japanese stocks have better valuations, but U.S. is going to have better earnings growth this year, mainly because of the tax cuts. So I would be buying broadly. Within equities, we're focused on areas like financials and energy.
Late cycle. Okay.
Yeah.
All right. Guys, thank you very much for coming in. Appreciate it.
Thank you.
Thanks, Betsy. Good to be here.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.